On my mind, gotta hustle and grind. Financial literacy always on my mind. I'm stacking knowledge, no time to waste. Gotta invest smart, gotta keep up the pace. I'm reading books, learning all the tricks, studying the market, making calculated picks.
What's good, everybody? It's your boy Reckless Raidinero, and we are back at it again with another episode of Portfolio Updates, this time for the month of November 2025. Before we get started, before we break this down, let's go ahead and hit the like, hit the subscribe, do the sharing of the video. Definitely share this with your guys' community. This is going to be chock full of useful information, probably a gem or two hidden in there. We're going to try to be as entertaining as possible. We'll see how it goes. Some people rock with it, some people don't. It is what it is. We're going to talk about our portfolio for the month of November, the moves made, how we did, what we experienced, and our logic and philosophy moving forward. Oh, never mind. That we need to go to there. And let's go ahead without further ado. Let's go ahead and get in here. I'm going to micro machine myself down in the corner. I've still got last episode's stuff up here. So we're going to start off, obviously, with our long-term holdings. Now, obviously, we are recording slightly in the first week into the month of November. Just because of the way rolling off a holiday, the way that stuff worked itself out, we ended up having to push things back a week, but we are back. We are still on schedule and we're getting the job done. So first and foremost, we're going to look at the long-term holdings. What do we have in here? Obviously, we have our SCHW, or Charles Schwab, because that's the platform that we're utilizing for our primary income portfolio. We're up to 6 shares. I do have drip on for this position and fine about it. Obviously, every month we buy an additional share, is what it is. Looks like what it looks like. The experience is what the experience is. Followed by our next new entry, Sofi, which we have 2 of. Deal with this position. We took out a very large loan, which we used to purchase a vehicle, amongst other things, from Sofi. And, adding it into the fold, we are going to go ahead and invest in it for the next 24 months. So we should end up with 24 shares. It is highly volatile, bouncing all over the place. I like it. It's super useful. I've never gotten money faster. It's crazy. It's really one of them things. So it's a super useful tool. It is something that I am happy to have added into my tool belt of potential areas to draw capital from. Probably not necessarily a preferred, but I understand why people use it and how it can be utilized to move yourself ahead. And then last but not least, our new entrance, TSII. The reason we put this over here and not in the primary income portfolio is we are looking for positions, and yes, this is set on drip. We are building a position specifically with this style of high yield. It's performed very well. These are long-term holdings. It does also prioritize growth as well as income. I can do less with the income on this versus the ability to build these positions up and use this to save up to convert over to shares of actual Tesla. So there will probably be a couple of more. I'm definitely going to be looking at adding in a chunk of MSII, which is the equivalent of TSII for MicroStrategy. And I know all the MicroStrategy high yields are getting poo-pooed upon right now, but it is one of those things that I am looking at where you can just build up this position, and as the position grows over time, you can either take that income and put it towards purchasing Tesla shares, or you can save this up in this position until it gets high enough to convert over to a share of Tesla. Either or, it'd be more or less dealer's choice. I'm going to in the onset, the goal is to drip into this position until it is producing enough money over the course of the month to purchase at least one share of Tesla a month. And I will do a replicate of this that'll sit down here in this zone of MSII, specifically targeting being able to snatch up shares of MSTR. Granted, with MSTR dipping like it is not beyond plausibility to just buy MSTR shares outright. Unfortunately, over on Schwab, we're not capable, or at least I haven't seen on anything that I've wanted to buy partial shares on, to be able to just buy partial shares. Like, I have problems selling partial shares on positions. So it is what it is, but we've got this set on drip, so that way this one can start building itself up as well as when I'm dollar cost averaging into it. And that's gonna take us through our long-term holdings, which cool. We like that. Next, we're going to show the in-home banking, which is, this actually will be dropping off, and we're going to talk about that. In-home banking, we're looking at the in-home banking position. So what do we have in here? We have the STRK. That's basically all that's in here. It's got some dust from other positions. The STRK is our house savings. We build up by about one share of this a month. At the end of the year, which we just pulled, we pull out an additional payment to space that mortgage out. We are doing that until we get out to about 6 months. I do like as much of a cushion as possible. At present, we are at, it's either 2 or 3 months. I just now started doing this. I kind of try to do this every year because you never know what's going to come up. You always want to prepare for the worst, hope for the best. We were previously holding our in-home banking in here. That, now that we have done the financial restructuring, which I do have an episode coming on, we're going to do a full breakdown. It's actually probably going to be a 3 or 4 part deal. And the STRC position that we had in here, we went ahead and liquidated that out. Reason being is, since we are running everything out of that primary income portfolio, we will have no need for that pool of money sitting over here. So what we're going to do is we're going to take that pool of money. We are going to put that pool of money into the primary income portfolio and put it to work, because at present we don't need it over here, because we won't be using that. If we need margin, we will be pulling that out of the primary income portfolio. If we need to take a loan, it'll be coming out of the margin of the primary income portfolio, because right now we are running that flat. We are running that on cash. So we're prioritizing paying this loan back first. This is the current deal that we're looking at. And next paycheck will be the final payment for this loan. So I've got 2 more weeks as of this recording before that's knocked out. Actually, 1 more week, because when you guys are seeing this, it'll be the week after this. So we're about a week out from having that fully paid back. The next thing that we're looking at, so this will be house savings, and that is what it's going to be. I think we'll probably swap this out with tracking the Robinhood portfolio, depending on if we bring back the Bag Fortification Fridays, because that portfolio is going to be boring as well, but at least on the interim. But we will be I'll be more apt to swap it out with this because this won't have anything to talk about, really. We'll be getting one share of Strike a month, and, you know, that'll pretty much be it. These come open business. This will be yesterday. We'll have these funds will be transferred over and dispersed into the high yield in primary income portfolio. And I think that's all we've got for the in-home banking, because that's going to be going away because we're not utilizing it. I mean, 90% of this was just me paying that back anyways, the way that we were running it. Now comes for the one that we've all been waiting for. Go ahead and jump into the primary here. The primary income portfolio. So let's scroll that up there. This one actually has context, so I need to get over into here and open up the snowball so that way we can see that. Perfect for the context. Do it for the culture. Okay. So primary income portfolio, for those of you who aren't looking, let's talk about the positions we have in there. Currently, we'll give a breakdown. Set up at the top in the equities. So we have some equities in here now. We have one share of STRC. That is correct. We've got one share of STRC. We will be getting one share every 2 weeks. Reason being is this is obviously a backstop. This is going to increase the amount of margin we have access to. This will add more portfolio stability. It is a semi-cash reserve position. I really am trying to not liquidate this, though. It's going to become the core of the portfolio at some point as we are building this portfolio out. One of the things that I am constantly looking at is planning ahead, which is actually pulling some of the volatility out of this while keeping some cash flow. So one of the meta games that I'm playing with myself as I build out my wealth is goal, get to $500,000 in STRC. At that point, I can I'll be at coasting speed. That's a salary, because $500,000, $500,000 in STRC, you should be getting about $50,000 a year. That's more than most people make right now. Like, I mean, honestly, like, that's an easy living just in that position. And we are starting that in this portfolio. It's the checking account. It's just building the checking account. I'd rather build it here and move it to somewhere else than have it somewhere else. So to keep it at the front of the mind, keep me focused in on it. Every paycheck, we're getting at least one share. With the restructuring, you're going to have a lot of movement in this portfolio. It's going to start growing now because there's going to be roughly at least a couple of grand a month flowing in here. We're doing the pilot over December, but this is where the money lands. This is the first stop, is this portfolio. Next up, we have blocks. This is what's left after we liquidated our cash reserve out to buy some more TSLW and TSYY. We ended up getting our cash dividend, which put us back at one share. I've still got that set to drip. It's still a cash position. It got brutalized over the month of November, as did the rest of the portfolio, but here we are on the other side of it. We've got 1.2717 shares of block. Next up, we have TSLW. The reason we have this in here, obviously, it's our Tesla play. Tesla, we are going to be long on. We are adding it into the long-term holdings. It's Bitcoin adjacent. It's not riding the same wave that Bitcoin is, but the company itself does have Bitcoin on the balance sheet. They are not a Bitcoin treasury. I like that personally. So after we got stopped out of Misty, we have not gotten back into position on Misty. And we're not getting back into position with Misty. We'll be using MSII in the long-term portfolio. And then I got some plans for something over here. as far as a MicroStrategy based project potentially. But TSLW, we added this as a counterpart to TSYY because I want that uncapped upside. I want to catch those bounces. I like catching those bounces. TSYY does not function that way. You're not going to get the upside pump. TSLW gives you the upside pump. Now we'll be able to jockey these as we get into uptrending markets where, you know, maybe we capitalize on some of the upside on TSLW when we do have some spikes. If we have a good NAV spike of about 30%, maybe we start cutting some shares off and putting them into TSYY to get the sustained income. The income on TSYY is better. We are currently at 400 shares of TSLW. Not complaining about that. Kind of looking to get to about 1,000 shares. I definitely want to get this position. I think that's where my target's going to be for TSLW, unless we start hitting some massive spikes, is to get this to 1,000 shares as well. I think that would be pretty awesome. That's a grind, and it's probably going to take us a while to get there. Reason being, but we'll talk about that here in a second. Next position we have is TSYY. My magic bullet. Personally, for me, from when I got in on it, it's been a magic bullet. This is the workhorse in the portfolio, and you know what? We rode it through the darkness of November, and it served and played its position well. Total profits, what I look at and where I judge and where my stop losses are placed. I know it looks pretty ugly over here. It's showing a NAV gain loss of 18.51%. When we get over to Snowball Analytics, because I like to give the receipts before we give the context so that you guys know that I'm not fudging my numbers. My NAV, my total profit, I lost total profit, but I did not get down to negative 10% with this position specifically. So I didn't get stopped out on it. And I was willing to continue buying it through the dip because of the performance that I was seeing. For me, it's been a workhorse. Now I do cut at my stop loss percentages, and normally that ranges within 5 to 10% total loss, which means that, like, including the dividends. So I don't function off this number here that you see in your brokerage account. I don't even reference that. It's just something to look at to let me know, like, hey, you probably need to go check and see where you're at in Snowball Analytics, because that's going to give you the actual number that you're looking for. This number just doesn't look good. It makes me open up another app and go, is it as bad as I think it is? And fortunately, over the month of November, it wasn't. Next up, we have WPay. This is a portfolio balancer. This is kind of a lot of my leverage comes from here. Generally speaking, you kind of want this to be your largest position. Unfortunately, with the way that we've got this portfolio functioning right now, it is not, because it doesn't pay as well. So that would drag me out of the range that I want to be in. We'll be talking about that here in a second when we jump over to Snowball Analytics to have that conversation. WPay, I do like the position. It's diversification. I am not a big diversification person, which is why it's so hard for me to get this to where TSYY is, aside from it not paying as well. It was a lot easier for me to be diversified with ulty before ulty did ulty things. Obviously, we had to clip that position. Got out. It hit my stop loss. We were at about 10% total loss on that. That's fine. I make it up in other positions. Generally speaking, the portfolio is growing in the direction that we want it to grow in overall, because the income off here is not just being dripped. You'll notice that the only things being dripped in here are blocks and STRC, which are cash reserves. STRC is the checking account for this portfolio, which also equates it to basically being what's going to drive our margin in the future. Because, like, as we get these numbers start generating the income that we're wanting, we'll start going more into STRC, more into blocks, more into WPay, more into the things that balance out the portfolio. Now, I do have 1 or 2 more positions open for my workhorse positions. TSYY, TSLW are workhorse positions. We might replicate this potentially, since the market is currently just, I mean, MSTR is more or less bottomed out, which has me wanting to see if I could do this type of double up with MicroStrategy, do a MSTW and a MS, I think it's MSYY, and stack those two in tandem with this, with WPay as the balancer on it, and see what we can do. I don't know. Let's go ahead and jump over into Snowball Analytics so we can give the context. So here we go, Snowball Analytics. Let's see where we're at. So we are trying to be within, I'm trying to get close to 100%. We're currently down almost to 80, which is my threshold on the lower end, which means as the next check that we get coming in is probably going to mostly go to TSYY then. I mean, that's the only other thing that I have that's going to drag this number up, just in general. And if we want to go here and take a look at how that spreads out, these are the numbers. So blocks, obviously, we liquidated that because we stopped out. Numbers that we look at, passive income. This is the reason I like this application, and I like the way that it tracks my stuff. It gives me my context. So total profit, we are up 4.6% total profit for the portfolio. That's important to understand, especially since we're not indefinitely dripping everything in this portfolio. This portfolio is active. This portfolio pays all of our debt. Everything's coming out of this right now, especially with the financial restructuring. We got a portfolio value of $38,122.39. Breaking this out, we are at 43% TSYY, which we're going to have to buy more of because we need this back up to 100, and that's currently what we're working with, or we get to add another position that is another high yield position, which we might look at the graniteshares offering or the roundhill offering and add in another one of those to see what we can do to bring this number up. Because now that I'm looking at it, I've been making sure to parse out a good chunk of my buys to WPay, and it's not helping. So, and obviously our buys that we put in today are not registered. So this is actually showing lower numbers than what's actually in there. This will get updated on, well, this will have updated yesterday, but I'm recording it when I'm recording it, which is before the financial update video. So this is coming to you on a Tuesday. Happy Tuesday. And, the numbers are what they are, but that's the reason I always show the actual brokerage account. So that way, like, this is actually under numberage. These numbers aren't even accurate right now. And they're on the low side. So we're at 83.89. Not bad. Definitely in some, as far as dividend people. Now we talk distributions over here, but the dividenders, this is Captain Insane territory, which I understand. I'm fine with that. Go ahead and put that down. But those are the numbers that we're looking at. I want to be positive total profit or at minimum flat. Like if I'm getting paid and they're like, well, you're getting your own money back. Well, if I'm continually adding money to the pool and I'm getting my own money back, like I'm also fine with that because I'm not reinvesting every cent of distribution that comes in. Matter of fact, right now I'm going to be reinvesting 0 distributions that come in, more or less, because they'll be going to other places. So as we get down here, we're looking at the growth. We're looking over the next 12 months. We're at $31,919.24, which puts us at $26.59 monthly. I'm kind of okay with that. I would really like to be over 3,000 every month, and it's just we were there, and then unfortunately the market went down. Ulti did ulti things, and here we are. That's kind of where I'm at with it. It's just like, okay, so we're gonna have to fight to get back up to 3,000. Obviously, we're gonna have some months. They're saying December should be a $3,000 month. Here for it if that's the case. Excited about it, but I don't I'm more looking towards leveling this out at where the short months are $3,000 months and the heftier months are like $4,000 months. Our dividend growth though is looking pretty awesome, with the exception of we actually are now hitting some of these months. So like November of 2024, I actually had more dividends come in than I had in November. That I am not excited about, but it is what it is. Like I said, this is not consistent. And this is actually the first month where I'm like, oh, like we did not beat that month. That's crazy. Like I'm trying to figure out what was going on that month. This still has us hitting our goal in 2026, which with the financial restructuring, there's nowhere we're not, because we will have at least $60,000 parking in this portfolio at this point over 2026. We're 53% to goal. That's adjusted. This updates every time we get to our get our payments in. So hopefully as the dividends go back up, so does that number. We start getting close to that goal. One other thing I want to look at in here is the position total profit. So blocks, which is a minuscule part of our portfolio now, that's obviously down 23%. It's dragging some numbers down, but it's dragging it down a little bit, not a whole lot, because there's not a whole lot in that position at the moment. TSLW, we're back green, up 2.35%. Now, what we'll be looking for is about in total profit. Well, actually, no, because I just look at the NAV on this one. If I'm going to do any sell-offs, it's going to be it'll be a NAV induced sell-off. But I am also looking at the dividend yield. So at present, it's 59. Hold on. So the 51.09%, that's low, but it's a counterparty to TSYY. So now that it's running and we're in the green, we're at 400 shares, we might let that ride and just focus on TSYY, because TSYY, we're sitting at 137.01%. And as you can see, our total profit, it's down 0.62% now. We're on the bounce back. As long as that's basically flat, that's where I want it. Like that's in the sweet spot. TSYY is in the sweet spot for me right now. It's in the sweet spot. We're at 137% yield and it's staying flat. Now that's from when I got in, but that's awesome. That is awesome. So like if we're sitting here and it's flat and then we're buying it and dragging down the NAV as far as the brokerage is concerned, awesome. So yeah, our next check for sure, if we're still riding around this range, hopefully we're doing a little bit better here in a couple of weeks, but I might just be going straight into TSYY, because WPay is dragging my average down, which is our last one. We're at 170, or well, no, we have more shares than that now. Where are we at? We're at 185 shares currently, showing 175 here. I've bought 10 shares since then. With a dividend yield of 38.54%. Now, see, that's the difference when you have stable, less massive shifting positions that are diversified. You get less yield. That's the drawback. So, both of those positions are dragging my averages down, so I'm going to have to not buy them for a little bit. 38.54%, which is freaking cool. I'm here for it. We're down 5%, 5.18% on the swing back up, I'm fine with that. Total, we're down total profit currently for the current holdings of 3.03%. Fine with that. I'm okay with it. That's a good healthy range for a high yield portfolio. I mean, we're getting paid. Debt's getting paid. People are getting paid. So the way that I look at this and the way that I break that down is I'm pleased with the fight that we had over the month because it is not easy buying red. And I'm going to tell you, as somebody who just spent a whole month eating crow buying red, it's not easy. It's not fun. It doesn't feel good. It feels good when the numbers start turning back in your favor. But this is a income portfolio. I don't even have this problem with my growth portfolios because I just don't look at them. Like, I really don't. Because, like, I don't have anything to do with it. I'm like, I'm not getting paid. I don't have to go check to see if my money's there. So I can just look away from that. And then, you know, at the end of the month, you go through, you do your buys, everything's red. Price, you're dragging your cost basis down a little bit, no big deal. And then you look away from it until the next time you have to go buy. With the financial restructuring, I will be having to peek into those portfolios a little bit more because we'll be getting to a point where we're more regularly getting into those portfolios. But overall, I don't have an issue per se with any of the stuff that we went through over the month. And I'm proud of myself for continuing to buy. Like, that was my thing. It was like we got stopped out on ulty. We had to pivot off of that. Redistributions, bringing in TSLW, Tesla taking some body blows over the month. Like, those ETFs weren't doing the greatest. Being able to mitigate our payment. And then we came out on the other side and we're still above our 80%. And, you know, checking and doing this video, just talking about it regularly. Now I know, like, hey, next couple of checks, you need to either be going in on TSYY or you need to start bringing in your next position. And I am limiting myself because I don't think I need 15 positions in this portfolio. I need like 6, maybe. I need 5 active ones. And then the rest of it's just stabilization and adding to my margin pool. I'm building my margin pool up. Because STRC, that's not a position I'm trading. That's just going to sit in there. That's the checking account. Blocks may or may not stay. We're going to be adding SATA as part of our checking account as a hedge, just to kind of play that market. So we'll be doing STRC and SATA. That's going to be another one. We'll be doing a breakdown on both of those positions, but those are going to be checking account-esque positions. I'm also going to be looking at, converting the Robinhood portfolio over because that's going to be functioning as most likely the in-home banking portfolio moving forward, because we're going to be using that margin over there because we get $1,000 in free margin and the margin is just lower. So being able to have that portfolio sit over there and do what it needs to do and not have that variability. I don't know that I need to have that be a high yield portfolio at all. Like, that might need to just be a straight pure play checking account with some extra stocks in there. Like, that's just a stock account. And so we might be, deconstructing and reconstructing that portfolio as well, just because of what we're doing, what we're going to be utilizing it for. Because if you just need a cash pool, I just need a cash pool. I don't need all sorts of other stuff going on in there. Like, I need a cash pool and some stocks. Like, which will simplify the way that I'm investing, because I was originally, mulling around like, hey, do I need to bring that portfolio over to this portfolio and just merge them as well and then start rebuilding that? But now that I'm thinking about it, I'm like, hey, like maybe we just need to get rid of the high yield out of there and dumb that down to just a pool of cash that produces some money. Doesn't need to produce all the money, just needs to produce some money. Yeah, it's some stuff to think on. Overall, November was a good month for my portfolios. Bitcoin went down. We got some buys. That's cool. I'm not seeing, you're going to take your body shots, but we're getting better at taking them. It's just like, hey, this was a bad month for them. Not the greatest month for the market. Bitcoin's kind of in the toilet. We're below 90. Ugh, ugly. Don't like talking about it, but it's not over. And we're going to get some good buys in at a decent price. And my cost basis for Bitcoin is like $30,000. So for me, like, it's like, how bad is it? It's not that bad. The TradFi portfolio, kind of bad. But not as bad as Bitcoin. So it's what it is, and we're still building, and we're still able to move forward, and none of the portfolios got nuked. Like, they're still functional, and everything didn't go to zero. It's not all over. We're not packing it up. We're just strategizing and moving forward, and getting a little bit, actually I'd say getting a lot bit more efficient. Like, the efficiency on what we're doing is kind of starting to pull some stuff together, where I'm like, okay, like we can make this work. Like, this is something I can work with. So that's exciting. Hopefully everyone survived the month, and like nobody completely cashed out and ran for the hills. I didn't. But I know, like, it's not easy having a month that you're getting all the good news, because Bitcoin was getting good news all month. That was the crazy thing. All the good news in the world, and then the market's going against what's going on. It sends mixed signals, and it's very hard to have the wherewithal to tune out the noise. And by noise, I mean like basically all the gurus and pundits and whatever telling you that the market's over. Because then when the market turns around, they're going to switch their tune, and they didn't lose anything, and you're out of the market, and somebody bought your position, because there's a winner and loser on every trade. And it seems like a lot of the noise is setting you up to be the loser, and I'm just not trying to live that life. So that's where we're at. That's what we've got going. Overall, numbers wise, a lot of red numbers, bad month. Experience and optimistically, we're set up for December. Or if we get a Santa Claus rally, I'm going to be set up for that. If we don't get a Santa Claus rally, then I'm going to be duking it out just like I did in November, and we're still going to get paid, and we're going to flip that money the way that we need to with the financial restructuring. We will be buying a lot of dips. And if that's what it is, that's what it is, as long as the money stays right and we're able to at least manage what we've got going on, which is what the pilot test is going to be testing. I'm good with it. Like, that's the way that I'm looking at this. Like, I'm like, if we can get to where we can at least manage this and chip away at that debt a little bit, I would be willing to ride whatever bear market we're going through, as long as I've got the money to manage and chip away a little bit at the debt. I can do what I need to do on the other end to facilitate what needs to be done. Otherwise, until we hit that run, because once we hit that run, that's going to change everything, because we'll have such a hefty foundation built that if we're stuck like this for a few months, I mean, we're planning on running this experiment in some form or fashion regardless throughout the first quarter of 2026. what we're going to be doing over the month of December is testing to see what is going to be the most efficient way to actually roll this experiment out. Because like right now for December, I think I've got 90% of my W-2 income just going into the brokerage account with the intent of using the majority of that to just buy stocks. And then using the distributions to handle the debt, the SoFi loan repayment, and whatever else I have come up. The other piece of that is going to be figuring out if that's actually possible right now. Because, we've got a little bit of money, and I think it's enough for us to deploy the Cash App flywheel twice. And if I can get that Cash App flywheel out, at least in the iteration that it's in right now, 2 times a month, then that should put me at where I can manage a little bit. And then as we build, eventually we get to the point to where we're doing it 2-3 times a month. It's just a matter of getting that income coming in, but that also requires the market to go in the direction we need it to go. So there's a risk involved. And December will be a good testing month. If we get the Santa Claus rally, we'll get to see, hey, like this is what it could look like if things go in your favor. I'm assuming the first quarter of 2026, we'll get a taste of what we're going to get a couple of tastes of what it's going to look like if it doesn't go our way. Now, if we start getting rate cuts and all that good stuff and cheap money starts flowing back into the market, different conversation. And we're just set, and hopefully things just, go to the moon and K-shaped economy, and I'm on the right side of the K, and we really start knocking stuff out. Because as soon as the cheap money starts flowing, this consumer debt goes away. Like immediately, just because the tools that we'll have available, the income that we'll have available, the market's going to start running hot. It'll be unrealistic. People will be talking about how everyone who bought now is a genius, and it'll be great. That's best case scenario. I don't know the best case scenario is going to exactly play out like that, just because nothing seems to have been going the way that it was supposed to the whole time. But we prepare to strike while the iron's hot. We win no matter what. Which means that, like, if we do get a good little healthy run Q1 of 2026, we're focusing on getting rid of that consumer debt. Because I am now in a point to where I've seen the way that an administration can change and affect the markets rapidly. And it's like you gotta harvest while the sun's shining. And one of the easiest defensive positions to have is to not have consumer debt. Now, I'm not saying I'm not going to have asset-based debt. I'm not going to say that I'm not going to use tools to buy assets. It's the credit card debt that was building and mounting from the surgery that we're still carrying, like those little additional things. That's the stuff that I don't want. I don't want to deal with it. Like, I want all that credit card debt, that $26,000, I want it gone. That's the weight. If it was $26,000 that was tied to the portfolio and we were getting paid out and that was what was managing the loan, I wouldn't care. I don't care about the $35,000 SoFi loan for that exact reason, because a good chunk of that is working in the market. It pays for itself. And I get to drive a dope car. Like, that I don't really, that's not my problem at the point in time. Like, the problem is the stuff that's going on the credit cards and like looking at these credit card numbers like fluctuating and finance charges. Like, that's where the issue lies for me personally, because stuff that's tied to something that produces income, generally more or less pays for itself. And if I got to come out of pocket for something, it's not the whole bill. Like that's kind of the important thing for me. So we're going to keep plugging away. The experiment for December is already set in motion. We've had the first check come in. We had to, I realized that the first barrier that I ran into was, oh yeah, mortgage, my part of the mortgage. I gotta pull that out. So I do have to pull that separate. But outside of that, the rest of it, we're good to go. So now we know, okay, so like there's the mortgage piece of it. Like whatever, that's a 1 day turnaround. I'd still rather have all the money go into the brokerage account and do it that way. And, like moving forward, depending on how I'm choosing to put that money in, it might be a position where like you park it in STRC and collect the dividend and then sell the STRC off and you get to keep the dividend because I have a set to drip. Like that could also be something. And then I just pick which day I'm going to do the payment and we just park everything in STRC and then get those dividend payouts. And as that dividend payout comes in, like you're getting to stack it off that. Like that might also be something that we look at. I'll have to check and see because I now have a 2 to 3 month cushion. So like I don't even have to wait. I don't have to do necessarily the payment the way that I'm doing it now, which is like, oh, as soon as it comes in, I just pay it. It's like, well, you don't have to because like you don't owe it until 3 months down the road. So, maybe it's buy as many shares of STRC as you can and then set it up that way. And then as it comes in, you do it after the dividend day, sell off, pay the mortgage. Oh no, we're gonna have to see how that works. But it gives me a little bit of leeway, a little bit of options. We can see if we can optimize that. But till next month, it's your boy Reckless Ray Dinero. This has been a portfolio update for November 2025. Do not forget to like, share, and subscribe. All free ways to support your boy and help the channel grow. Till next month, my peoples. It's your boy Reckless Ray Dinero, and I'm out.
Money on my mind, yeah. Focus, got no time for games, nah. I don't play, man, I'm all about that financial literacy. Investing in my future, building generational wealth. Dollar bills, they be calling my name, but I ain't chasing fame, I'm chasing change. Learn the game, now I'm playing it smart. Putting my money to work, it's an art. I'm stacking paper, building my own empire. No more living check to check, I'm getting higher. Investing in stocks, real estate, and more. Gotta secure the bag, that's what I came for.